Could you elaborate a little more on the attributes on the fund?
Sure. So first and foremost, we're always going to have at least 51% of the fund in floating rate instruments. So we will buy fixed rate securities, and over time that will change. I think as of late, we have been taking the allocation to fixed rate securities up to the extent that we think about the environment we're in around kind of accommodation and central banks easing. We're trying to protect some of that coupon. We have a fair amount of flexibility in the fund to invest in industrials, financials, utilities, the securitized area as well. And we will also have some government securities in there for very high quality securities. It's an investment grade profile. We can invest in multiple currencies. I think a lot of the products out there are typically U.S. focused exclusively. We will buy U.S. companies, we'll buy European companies, Asian companies, and we can also buy currencies, different currencies as well. So to the extent that we may find an opportunity in a company, well, then we have the flexibility to find the cheapest security that company is issued. And at times that may be a Euro bond, it may be a U.S. bond. So that flexibility is very important for us. And then there's also kind of a wide universe of sectors as well that we'll invest in.
And how would you say is this fund different from other floating rate funds that are out there in the market?
The biggest difference would be, relative to a lot of the funds that are out there, a fair amount of floating rate funds are actually investing in floating rate loans. Floating rate loans are typically made to high yield companies. So these are companies with a significant amount of leverage relative to investment grade companies. They will experience higher defaults through a cycle. They will also yield a little bit more. But for our fund, we're focused more on stability and we're focused more on investment grade. So we're not buying high yield loans. We're buying high yield, investment grade companies that have a rating of at least BBB. It's a global fund, as we mentioned. So a lot of other funds are more focused on the U.S. Would probably be the biggest differences.
Carl, you've mentioned income and price stability as key attributes that investors look for. The fund has not had a negative calendar year on a gross return basis since inception. Now, that's remarkable because not only does it include the year 2022, when the global aggregate bond market was down minus 11%, but also 2019 and 2020 when interest rates decrease. When we speak to investors, however, there still seems to be a common misconception out there that interest rate cuts by central banks, all else being equal, would have a negative performance impact on floating rate notes. Could you maybe explain to us how floating rate notes behave through a cycle?
Yeah, it's a good point. I think we're certainly having a lot of conversations with clients and distribution channels kind of around some of those points that you made. And I think it's good to kind of go back to the feature of a floating rate note, right? To the extent that there's a negative connotation about interest rates coming down, whether it be the Fed funds rate or the ECB lowering the borrowing rate, that negative connotation is a little bit misguided in that there's no negative price action as a result of that, right? Because the floating rate instrument is going to reset. Coupon may come down, but the price is going to be stable, which we talked about. So to the extent that we think about the capital that folks are investing, there's very little capital risk associated with those declining interest rates. The other part of it would be that the fund is still producing income. That income may go down moderately as interest rates come down. But as we mentioned already, we're very confident that we have no intention of changing the dividend of the fund. So we've already seen central banks cut, and we're maintaining the dividend at 6%. We have some flexibility around what we can do to the extent that interest rates are coming down through buying more fixed rate securities, owning less floating rate note, owning corporate bonds that have a cushion. So we are building up some yield. That's kind of the plus part of the portfolio, if you think, right? So we have the ability and that flexibility to still protect some of the income that the fund can generate. And I think another part of it would be, I mentioned in 2022, we also have the flexibility to invest in maybe higher quality companies, maybe more towards the end of the cycle. So in 2022, we didn't have a high allocation to high yield. we owned more high quality companies, and that's something we've been doing as of late as well. So we have some flexibility, and we work very closely with research around that to really be in more higher quality companies now, because we don't feel like we're being compensated as much for some of the lower quality companies.
We have seen a lot of interest from investors out of Asia. In fact, when you look at the statistics, 44% of cash deposits in Hong Kong are held in US dollars, where the 10 largest traditional banks currently offer interest rates of between 2.5 and 3.8%. That compares to a US dollar SOFR rate of 4.3% and a distribution yield of the fund of around 6% currently. And even in 2021, when money market rates were close to zero, the fund was still able to distribute more than 2.5%.
The fund will almost always generate a higher yield than bank deposits in conventional money market funds. And it's really around the design of the product. So to the extent that we have a much wider flexibility, right, in your conventional money market fund, typically cannot buy a security beyond a 12 or 13-month maturity. So our ability to buy 2- and 3-year high-quality corporate bonds is going to build a little bit more yield in the portfolio as a result. Our ability to maybe buy some securitized products. So it's really about that wider discretion. The other part of it would be that the credit curve, so U.S. corporations or European corporations, their credit curve in terms of what you get paid to lend the money, buy their bonds, is typically steep. So as you move out the curve 1, 2, 3 years, you're typically getting compensated an extra 10 to maybe 30 basis points a year to move out the curve. So we're trying to benefit from that. So we're trying to buy those 3-year securities, and as they roll down, we're continuing to get that income into the portfolio. So that steepness of the curve is a benefit. And then I just think the overall flexibility that we have. We can generate alpha through security selection to the extent that we're looking at different companies in different markets and generating alpha through issue selection as well.
You've mentioned the important role of our trading and research capabilities a few times also in your introductory remarks, and their importance to generate alpha as being embedded within the process. Can you give us a few examples of how the fund benefits from these?
I think maybe using an example of right now, and I mentioned that we're currently more focused on higher quality companies. So if we think within a sector, we are very fortunate. It's a big benefit for us to have those 20 plus research analysts who are located in Europe, Asia, in the US, and very focused on specific sectors. So we have individuals who have been covering a specific sector for 15 to 20 years. In those instances, we have the ability to benefit from, they'll build a model on a company. So we can have a very deep understanding of how that company has performed in previous stress scenarios looking back. And then we also have the ability to look forward, right? And understanding what do the earnings look like? What are the capital requirements? Are they going to change? How is that going to affect the company? And then really important is that we're able to do that in a way, it's a proprietary model, right? It's our own. We're not relying on the rating agencies to really discern risk. And, for the rating agencies, they're paid by the issuers, right? So we've seen in instances in the past where the rating agencies can lead you astray at times. We can think back to 2007 and 2008. So relying on the proprietary research is very important. In identifying companies, we're really using the research folks to do that. When we buy a bank or we buy an industrial company, there are hundreds of securities that each of those institutions have issued. And we're using the trading desk to help us find what's the cheapest bond. Maybe there's a 3-year US bond. Maybe there's a 2-year Euro bond, right? So once we've identified that high quality company we want to invest in, then we want to find the right security. So it's really working with research and trading to do that, working together with portfolio management.